Welcome to Clarity Financial's weekly Underbelly podcast, where we dig deep, discussing financial topics few advisors dare to tackle, and share thought leaders from the world of finance, covering important topics like Social Security, Medicare, retirement planning, and asset protection, providing you with personal finance ideas, not just to save you money, but make you money. Now, the Underbelly podcast,
giving you the edge
and arming you with money truth. And good afternoon. Welcome to the Underbelly podcast. I'm Brent Clanton, along with Richard Rosso, our Director of Financial Planning. We're going to talk reverse mortgages today. And Richard, why don't you introduce our guest for us, please?
You don't have that screaming, like when you hear reverse mortgages. Hey, yes, you know, as part of what we do at Underbelly is we want to go where no advisor wants to go. And where we go, though, is very, very important, I think, for a majority of Americans who are trying to manage retirement cash flow. So today, I am very, very excited to have Tom Dickson on. And Tom is a national leader, financial advisor channel, but he is with Reverse Mortgage Funding. And, Tom has been a thought leader on a lot of academic research on reverse mortgages and what they should be used as, and as a portfolio management tool to improve client outcomes. So he's got much published research. He works designing enhancements for financial planning programs, specifically Money Guide Pro. And he also manages the Retirement Experts Network, which is an online educational platform designed to help financial advisors learn more about important retirement issues. And I will say, Tom, you guys tackle a lot of stuff that I think is very important, including Medicare enrollment. I mean, all the things that I write about and talk about, you guys are trying to really educate the financial advisor community about topics that I don't really think that they spend a lot of time with, frankly. And I think that it's great that you're doing that along with continuing education. So I want to thank you for that.
Oh, thank you. It's kind of you, Richard, and thanks for having me on the show today. I appreciate the opportunity and find it interesting that you lead with the fact that many financial advisors don't necessarily proactively tackle the topic of reverse mortgages, though I think in part we're starting to change that mindset.
Yes.
So kudos to you. As always, I appreciate your thought leadership here as well.
Well, I became very interested in reverse mortgages around the time of the financial crisis, when we had to help manage clients' cash flows, and we had to tap alternative sources to allow portfolios to heal, frankly. Even though we did have a sell discipline, we did have quite a bit of cash, we were also hesitant to have clients take money from their accounts. So we had used cash values of life insurance. For those that were still able to hold their home equity lines of credit, we tapped those lines of credit. And because I don't know if I'm sure you remember at the time, banks were sort of closing those down left and right. But I was
absolutely
lucky to have clients that still had them, and we were able to utilize them. And the goal was, when the time came when we could rebalance and take money off the table in a time of strength, we would pay off those loans. And I got very interested in the home equity conversion mortgages and how they work. And I really started to dig into some of the work for my book in 2012 of Harold Levensky and so forth. So I think it's going to be very, very important because of the fact that the home is the primary asset for most Americans. But what I always equate it to, Tom, and I tell people, it is a block of ice. And you need much water in retirement. And if you don't want to leave your home, how are you going to do that? But when you bring up the words reverse mortgage, man, people cringe because they have this stigma about reverse mortgages. And I get it. I mean, I get it, the high commissions that happened at the time, maybe the misuse. But I thought maybe we could spend a few minutes, you spending some time talking about, well, first of all, what the heck is a reverse mortgage and what are the requirements? And then second, what are some of the myths and why have they developed when it comes to them?
Sure. Yeah. Let's start with the what is it?
Yes, let's because I don't know if people really know, so I thought you could really give a good overview of that.
Yeah, I agree with that. So, simply said, a reverse mortgage allows a homeowner, 62 or older, to convert the home equity they've built up in their house, typically over decades or at least many years, right, into some form of tax-free cash. So I like your analogy of the block of ice. For those of us that have this home equity showing as an asset on our balance sheet, for many of us, it's not liquid. Again, I love your analogy. So really, what a reverse mortgage at a very basic level allows a homeowner to do is to access that home equity and turn it into, and here's a key part, tax-free cash.
Mm-hmm.
So, and there are a wide range of payment options in terms of how they could access it, but it's very, very at a very fundamental level. That's what it does. I'd also like to add quickly too, Richard, that you referenced the home equity conversion mortgage. Many people are surprised to learn that far and away the most popular type of a reverse mortgage is actually one that's sponsored by the federal government, and it is known as a home equity conversion mortgage. It's been used by over 1 million older Americans, again 62 or older, to help secure their retirement for a wide variety of purposes. So I think that we believe as an industry that government sponsorship is really important.
Mm-hmm.
It comes along with some significant FHA insurance, which provides some real protection to the client. So again, the most popular type of reverse mortgage is the home equity conversion mortgage sponsored by the government. It falls under HUD, comes with this FHA insurance. I'll just add in terms of eligibility, this works on your primary residence. It can be a single-family home. A condo is also potentially eligible under the HECM program. We call the home equity conversion mortgage a HECM, as long as the condo for that program is HUD approved. And then even multi-unit properties. So anyway, just to give you a little, some of the basics around how it works, Richard.
So again, you must have own your home outright, or at least have 50% equity in your home. And we'll talk about some strategies about how you may even use the reverse mortgage to pay off your mortgage, which sounds strange. But you brought up something very important. You brought up tax-free income. And when we try to help people create intelligent income streams in retirement, we're very sensitive to, one, Social Security taxation, and we're very, very sensitive to Medicare premiums and the IRMAs, or the additional charges for Medicare. And like a Roth, these are tax-free distributions that come sort of almost like a Roth IRA. Am I correct?
That's right. I mean, basically, it's just you could think of it as a return of equity or a return of principal. So again, any cash drawn from any kind of reverse mortgage payment plan. And there are things options such as, for example, a credit line or a monthly payment. Any of those dollars received are, in fact, tax-free. Absolutely.
Why do you think, what's happened as far as the reasons reverse mortgages continue to have, or how did the bad reputation start, and why does it continue? Although I know you've done a wonderful job. Many of us are trying to do a really good job as helping to demystify them. But what was some of the issues that you saw that created this stigma around reverse mortgages?
Yeah, that's a multifaceted question or multi-point response here, I guess, coming. But I think, like many financial products, it's not easily understood. And at some level, there's a bit of complexity, though. Again, if you boil it down at the simple level, it's just a way to convert home equity into cash. But I think the program's been around since 1989, the home equity conversion mortgage program. And I think when at its inception, Richard, there were some other similar programs that I believe in part caused the the reputational issues.
I see.
Those are no longer even in the market. So you sort of had that. There were equity appreciation programs that were not the home equity conversion mortgage. So you had a little confusion over that. But to be fair, the home equity conversion mortgage program has been improved significantly over the last 4 or 5 years. So some of the things that historically had caused some trouble were, for example, if you had a couple where it was perhaps the oldest spouse was 65 and the youngest spouse was 55 years ago, and I want to make this clear, no longer an issue today, but you might have had a case where both were on title, on ownership of the home, on the deed, and they might take the younger one off title and then put a reverse mortgage in place. Well, how that would become problematic is when the older spouse passed away, right, and the younger spouse is not on the title, and then guess what? The reverse mortgage became due, and that younger spouse was forced basically to either pay off the balance or move out of the home.
Yes.
So historically, you had some issues like that have really been addressed, where the younger, just to make sure everybody understands, the younger spouse could stay in the home in today's version of a home equity conversion mortgage. But I think it were some of the enhancements that have been made by HUD over the last few years have addressed some of the flaws of the program that did exist. And the researchers that you've alluded to in your opening comments, folks from the American College and Harold Avensky, my friend there, have recognized that these improvements have really been a big boost to the program. I think the cost as well.
Yes.
I think historically that was an issue. I think that it's a much more competitive environment today. I think just continuing to educate everybody, not only financial professionals but also consumers. I will share this statistic with you. Our industry association for the reverse mortgage professionals, NRMLA, it's called, measures the amount of positive to negative publicity that is put out on reverse mortgages. And whereas historically the negative to positive used to be, I believe I'm correct on this, used to be roughly 20 negative articles to every one positive, let's say 5 or 6 years ago, Richard, it's flipped. It's now 20 positive to 1 negative, the last I heard.
Excellent.
So, we're on a mission. We have to educate, and we do it day in and day out. And I think it's just learning the facts. I think there continue to be a lot of myths, and I think we just have to educate one at a time.
Well, again, there's a lot of research out there. If you're a financial advisor, you publish research. The Standby Reverse Mortgage, a risk management tool, which was published in the Journal of Financial Planning. Wade Thaw, Wade Thaw from the American College, Jamie Hopkins, who I'm big fans of, and Harold Avensky. But it takes sometimes, I think, more of the established financial types to really get on board with some of this, and that stocks are not this panacea, and there are other things that you need to do. And now, and I don't know how long this has been in place, you absolutely have to meet with an approved reverse mortgage counselor prior to even applying, right? There's a course or counseling that you need to go through so that you are well educated as a potential borrower, which I think is actually very much a positive.
I could not agree more. I think it's called a counseling session. So for anyone that considers a reverse mortgage, it's actually mandated by HUD that they have to actually have a conversation either by phone or in person with an unbiased third-party HUD-approved counselor that will actually walk the customer through the pros and cons of a reverse mortgage, ask questions, for example, geez, have you considered any other options, such as selling your home and renting? They are really an unbiased party whose job is to make sure the client really understands what they're considering and make sure they're not being coerced by anyone to use a reverse mortgage, make sure they're not being coached into trying to use the proceeds from a reverse mortgage to buy another insurance product, for example. So personally, I think, Richard, I wish this unbiased counseling was in place for every financial product. It's very unique, and it's a nice safeguard. The thing I would add too, Richard, is for anyone that's really thinking about this, either for themselves or for their mom and dad or a loved one, guess what? If mom and dad are going through that counseling session, they can actually invite their children. They can invite their financial planner like you.
Yep.
Totally open, totally transparent. Isn't that a wonderful thing?
I think it is. And part of the responsibility of this, I would just remember early on with reverse mortgages, I would have to counsel couples that had it, did not go out and blow the money, because we did have a situation where we saw irresponsibility with home equity lines of credit, that we saw some of that with people who took out reverse mortgage, that this was some windfall, as opposed to using it within a strategy. But what was that strategy? I didn't realize what I was helping to create at that time for myself, for clients, is something that would become what it's become. And I'm glad I was validated with some of the things that I've done. But it's great to see this full body of work on how to incorporate it. But it was also making sure that the couples understood what to do and didn't blow it. And that's that's a bit of a challenge sometimes. But for the people who were fiscally responsible and understood, we were able to utilize it properly. And I think that that's important.
Well, it's a great comment. You remind me again of one of the changes that HUD made to the program, the home equity conversion mortgage, just a few years ago, was they now, if a client qualifies for, I'll just use an example, let's say $100,000, and that's how much they would be able to access using a home equity conversion mortgage. HUD, again, just recently put I call it a guardrail or a guideline in place that you can only access 60%, 60, in the first year. So in other words, you can't, it's not like you hit the lottery and you say, oh, okay, I want that entire $100,000.
Exactly. Exactly.
So I think that's a healthy thing.
It is.
The other thing I would add too, Richard, is it's a very flexible program. So like in that example, we could say, oh, okay, let's set the client up on a payment plan. Mm-hmm. So to your concern about, don't go out and spend the entire balance in the first 2 years, we could set up a plan where they might draw $700 a month for X number of years. So you have a lot of flexibility. You basically can design your plan, and I think that's another way to help people make sure they use this responsibly.
Yeah, one thing I want to make clear is that when you do this, the lender doesn't receive title to the house. You don't lose control of your home. Oh, it's not my house any longer. Yeah, you still have to pay property taxes and insurance, the homeowner's fees. You own the home. You are the homeowner. So you've got to make sure that you have the financial requirements to take care of the house and that it is yours. It's just the fact that, especially which is so popular today, because we talk about housing in retirement with through a lot of our programs. And one is that aging in place is so very popular. Well, there's going to be costs associated with how to get your home ready. And if you definitely want to stay in your single family home and it's not really ready for you to, you can. And I will tell you, the kids love this, where they feel the family can stay at home and possibly even use the home equity line, home equity or reverse mortgage to, help with caregiver expenses and so forth. But one of the things I want to talk about with you is the actual ways this is done, the interest rates involved, some of the muddy stuff here as far as, as interest rates are going higher, how does that affect this process? So I thought maybe we could talk a little about, what exactly, because there's so many different types of rates attached to this. There's with this, there's the effective rate, the expected rate, and I just wanted to get people an understanding is, okay, if I want to do this and I'm eligible, how does that work? What is the interest rate based on, and how does this process overall work?
Sure. And I would start with the fact that really to get a sense of if anyone's truly interested, what you might be able to access using the home equity conversion mortgage program, or we actually have a proprietary product as well, and I can explain more about that in the minutes to follow, but called Equity Edge. But again, with the home equity conversion mortgage, we really need 4 pieces of information to give you a sense of how much money you might be able to access using it. literally the age, if it's a husband, wife, or same-sex couple, the age of the youngest of the two of you, a guesstimate or an estimate for the home value, if you have an outstanding mortgage, the mortgage balance, and then a zip code. Literally on those four factors, we can give you an estimate of, again, how much you could access using a home equity conversion mortgage. But to go to your question or questions, Richard, the question of the interest rate that you would be charged will vary, and I'm not avoiding the question. I'll explain it, and it really varies based on which payment plan is of interest to you or applicable. So you have either a fixed rate or you have a variable interest rate. The fixed rate is applicable when you take advantage of what we call a lump sum distribution. That means that, again, I'll use the example, if your home is worth $200,000 and you qualify for $100,000, you would be taking all of what you qualify for in one lump sum.
It's like, give me the money option.
Give it to me now.
Yep.
Now, having said that, that's most relevant. We see the largest use of that when a client has a traditional mortgage that they are using the HECM, the home equity conversion mortgage, to pay off. So using those numbers as an example, if a client had a $100,000 outstanding mortgage with the Bank of America or Wells Fargo, pick your favorite lender, they could potentially use, guess what, a home equity conversion mortgage to pay off that balance. That, to us, is generally what's known as a lump sum payment.
Which means I no longer have a mortgage payment, right? I mean, I've pretty much eliminated that process, and I might improve the cash flow of my situation. I no longer have this mortgage payment.
Absolutely.
Yeah.
Yep. And believe it or not, and sometimes people are surprised that even with the financial planner clients that we serve nationwide, that particular use right there is far and away the most popular use of a home equity conversion mortgage. It's getting rid of those mortgage payments, and it's really for clients that they're staying in their forever home.
Yes.
That's where we see a lot of interest, and they have cash flow issues, and they're putting their savings at risk by continuing to make those payments. Those are some of the characteristics we see.
Well, because more people carry mortgages later in life than they did before.
Nope.
So if you can go ahead and pay that off with the reverse mortgage, free up your cash flows to enjoy your life, that could very well be a viable option. But like you said, that is a fixed rate that is received on that. And but again, you're not responsible, even though there is a fixed rate. You're not responsible for as the homeowner or the spouse of the homeowner to pay that off like a home equity line of credit. Am I correct?
You're not, and I'll explain that a little further.
Go ahead, please.
The other part I want people to understand, though, too, is if you were to use a reverse mortgage or a home equity conversion mortgage, I'm going to continue to use the term HECM for that purpose, you still, or any use of a HECM, you still have the responsibility of paying your property taxes and property insurance and any other fees that apply.
Correct. That part, absolutely, yes.
And everybody should know that guess what? You have those same obligations if you have a traditional HELOC or regular mortgage, right? So it's no different in that regard, but I want people to understand that.
Yep.
Now, in terms of the payoff, I think what you were alluding to there, Richard, it's really relevant. You don't have to make any payments. That's the beauty of one of the big benefits of this product is, again, as long as you're in your home, you meet your obligations, it's your primary residence, you don't have to make a monthly payment. You always can if you want, but it's totally at the customer's choice. Now, when we get paid back, if you will, is when you go to sell or transfer title to the property, right? So if a client uses a HECM to refinance a traditional mortgage and they live in that home for 3 years or 33 years or whatever that time period may be, when they go to sell or they pass away and title is being transferred, that's when we have to be paid back. So again, as long as they're in the home, they meet their obligations. There's no due and payable notice. It's upon transfer is when we need to be paid back.
So that's one road with a fixed rate that you're going again. And then there's yet another road, right, where the rate is variable.
Correct. So the variable will apply again to different payment options. Specifically, let's think of the credit line option or a monthly payment option, right? So I'll continue with that example of the client whose home hypothetically is worth $200,000 and they qualify for $100,000. And by the way, that the amount that you qualify for is largely influenced by two factors. One is the age of the youngest client involved, and two, the choice of your interest rate program. And there's similar to the regular mortgages or traditional mortgages, there are a range of interest rate options, and they come with pros and cons, right? And those are things that we work through with clients, and we educate them in a very transparent way in terms of what choices are available to them with different interest rate options. So with that $100,000 example, just to make it clear, if it was a 95-year-old customer, the amount involved on a $200,000 home, the amount that they would be able to access would be larger than what a 62-year-old client could access. So I just want to again make that clear. But so back to that $100,000, the client, if they don't have a traditional mortgage, they have no mortgage balance today, they could either put in place a credit line that starts at $100,000, or they could choose to draw a monthly payment off of that, again, that eligible amount. So either or. Now, again, both of those payment plans or options comes with a variable interest rate. And again, that variable interest rate will range today, I'm going to say, literally by as much as 1.5% to 2%, the difference in the interest rate. The interest rate itself, there's the variable part of that is tied to the LIBOR index, which, Richard, you're very familiar with, and I would think many are. It's a benchmark for setting the cost of funds for many financial products, especially mortgages, right? So your interest rate could go up or down based on what's happening to LIBOR. Now, one important part I want everyone to understand, though, is if you start with an interest rate of, I'm just going to use round numbers today, of say 5%, right? There's a cap on what with our products at Reverse Mortgage Funding. There's a cap on the amount that interest rate, that variable interest rate, could rise. It's 5%. So let's think of a 62-year-old that puts it in place, and again, just hypothetically, they start with a 5% interest rate, and they have this credit line in place or a monthly payment in place, and they have it in place for, believe it or not, 40 years. Over the life of that relationship and having that option in place, the most they could ever have on that interest rate is 10%. Again, it can't go up by more than 5%. So that's a nice, I think, a nice protection for the client.
So I am looking at, say, for example, I'm 62 years old and I qualify for $100,000 from my house as a credit line. And what I want to do is I want to use this credit line just in case, and we'll talk about strategies on how to use this. So explain a little bit about this line of credit the earlier that I place this in. Now, I might be, once I have this credit line, I'm looking at it for a specific reason. Maybe it's to pay for long-term care 35 years, 40 years down the road. Maybe if my portfolio is not doing so well, I'm going to use it to take distributions. In other words, I'm going to use it wisely, but what I want to do is I want to place this line of credit in place at age 62, and I want to let it sit there, and I want to let it appreciate over time. How does that work as far as, say, what's happening with current interest rates, and what happens to that $100,000 that I look to borrow today? Does that $100,000 line of credit become much larger at the time I might need it in 40 years, or go through that just a little bit?
Sure. Yeah. Great question. Of course. We will continue on with the example that you start with a credit line of $100,000 today.
Mm-hmm.
For a 62-year-old, just again hypothetically,
Yes.
the amount available in that credit line will actually grow month over month, year over year. So for whatever they have available, whatever amount they have available in the unused or available credit line, that amount will grow. And here's the key: regardless of what happens positively or negatively to the value of their home.
Regardless of that, regardless
Correct.
of what's going on with the value of the home. Okay, got it.
Yep.
Mm-hmm.
So my go-to example is I'm going to change the number slightly. A 62-year-old that might qualify for, and this is a good way to introduce the fact that with the home equity conversion mortgage, the amount that clients may access is subject to an FHA lending limit. Currently, it's $679,650. So, again, hypothetically, let's think about a 62-year-old client whose home is worth even $1 million. The amount that we will make available is calculated based off the lesser of the FHA lending limit, which is $679,650, or the appraised home value. So, in that example, the clients, a 62-year-old couple, may qualify for roughly, let's say, $220,000. And so you would think of that calculation, the $220,000 or so, as a loan-to-value like calculation.
Okay.
It's roughly 32% of that $679,650. That being, if you take $220,000 divided into that FHA lending limit, right? So it starts there. But the key here is kind of the wow of this product is the amount available in that credit line, again, will grow, such that I'll take you to 20 years from now. The amount available, just using today's interest rate assumptions and the growth that we're forecasting, right, and basically it ties to LIBOR. In 20 years, when the clients are 82, the amount available in that line could be close to $850,000, $900,000. It becomes a very large amount. So, and if you go further out on the age range, right, literally at age 93, when the client, we started at 62, we started early, and this just really illustrates the power of compounding. It's all about compounding, right? Literally at the age of 93, that client that started with a credit line of about $220,000, right, has close to $1.9 million available to them in that credit line. And again, it's a percentage.
Mm-hmm.
It's being calculated times that available credit line. Again, in today's rate environment, we're forecasting growth of anywhere from 6 to 7%, and you're multiplying it by that credit line. And again, it's just compounding. So the key there is, if you put this in place at an early age, you make a smart decision today, you could have a very, very powerful asset, such that, I'll just finish off the example here. At age 93, you literally would have a credit line of let's call it $1.9 million that you can access, and whether your home's still worth $679,650 or $1 million or $300,000, it doesn't matter. This growth happens independent of what happens to the value of the home, such that you could then contact an RMF, for example, and ask that we deposit $1.9 million into your bank account.
So, and that's amazing, because this line of credit continues to grow, which I call the seed, and it grows into this tree that you're able to pluck all this fruit off of when you need it, and be very disciplined with that approach. So the current interest rate environment is historically low. If interest rates rise in the future, would that mean that if I open the reverse mortgage sooner, does that mean that line gets bigger, stronger? In other words, what happens as rates rise, or am I locked into a specific rate now? In other words, I want to see if interest rates increase in the future. Is that a benefit to me if I open this reverse home equity conversion mortgage sooner?
Absolutely.
Okay.
Yeah, sorry about that. Yeah, absolutely, Richard. And the rising interest rate environment has a positive and has a negative, like many things, right?
Mm-hmm.
The positive is if you have this home equity conversion mortgage credit line in place, or reverse mortgage credit line in place, the amount of growth you will realize on the available line absolutely will be accelerated in a rising interest rate environment. No question about it. On the other hand, the amount made available to you will be impacted, unfortunately, in a negative way, meaning that you will have access to less money as rates continue to rise. So
that's
there's an inverse
that's your
relationship.
negative. Yes, that's the
Correct.
negative part of it. Yes, you'll have less.
Yep. So roughly 2 years ago,
Mm-hmm.
I would tell you that in my example where I share that a 62-year-old would start with $220,000 or so today, I would say 2 years ago they might have started with $260,000.
Got it.
So that's the impact in terms of the starting amount. Now, the offset to that, Richard, is the compounding is larger, faster, better today because of the rising rates.
Right, because of the rising rates. So I was trying to figure out, because as you bring up that point, I can't control what interest rates are going to do today or when I'm 62 years old, but there's a positive and a negative to rising rates. And the fact is, I don't know which one's greater, but if I need this credit line, even though maybe in that example I lost $40,000 to some degree, I'm going to compound at perhaps at a greater rate over 40 years, and I'm going to have this big line of credit that I'm going to be able to draw from, which I think is very positive.
Yes, absolutely, and there's certainly we've done a lot of work, and folks like Wade Thaw from the American College and Harold Advansky and others. We've looked at again. The idea, the benefit of taking and putting the credit line in place at an early age, such as 62, versus waiting to 82, or there's the power of compounding. Again, starting the credit line as early as possible, always far and away outweighs the idea that, geez, I can get a little more money if I wait until 72 or 82 or an advanced age. It's just the growth in that credit line will just far and away exceed what you might get in terms of a little more money at a later age.
So there are always these types of different options of utilizing this line and different strategies that, say, a lot of the thought leaders have written about, whether you're using it to, hey, I'm going to pay off my mortgage at retirement and I'm going to use the HECM to do that, or I am going to open my line of credit and I'm going to exhaust my entire retirement account first, and then my last resort is going to be tapping this HECM. In other words, my $400,000 in my IRA 401k, that's gone now, and now I need to depend on this. So there's all these different strategies. I understand it's based on a personal situation, but is there one strategy that you think is most effective when it comes to utilizing a HECM to help with expenses in retirement overall and complementing the portfolio, which is variable in its approach, obviously, in stocks and bonds?
That's an interesting question. One, I think just frankly looking proactively at the idea of putting a credit line in place, to whether it's tied to the portfolio or whether you're really setting up the idea that you could use it for healthcare expenses, be they in-home, be they out-of-home. I just think fundamentally it's something everyone should look at proactively. I would say, I guess I would share, Richard, where I see professionals using this. I'll go back to number one. Paying off traditional mortgages is far and away 68% of all the financial advisor cases we've seen at RMF. Approximately the last 2 years involved just that use. I think number two, the credit line, the idea of setting up a credit line as a standby, as Harold would refer to it, Richard, is the second most common strategy or use that we see. And anecdotally, I would share that, because we work with hundreds of planners from all over the country. I think people are really using it as an alternative where they do not have long-term care insurance.
Yes,
that's where we see it used. I think that's personally the most popular use. Now, having said all that, I think to your point and your belief, and obviously I share this belief, having been involved, and I helped sponsor the research from Harold that started back in 2011. Was involved just in a very, very small way. I certainly don't want to take credit for that.
Sure.
But I think having a resource, Harold's, I think, epiphany or kind of aha moment when he learned about the credit line and the fact that this available credit line would grow regardless of what happens to the value of the home, and it can't be canceled or frozen. Very important for everybody to hear that, unlike a HELOC. And I was meeting with him in Coral Gables, Florida at the time after they had been through the Great Recession, and he had a lot of wealthy clients whose credit lines, whose HELOCs were canceled.
That's right.
When he saw,
That's right.
Exactly. He saw how this worked, and he's like, wow. And then the light bulb moment for him there was, geez, if my clients could access this resource when there is a down market, and so when my holdings are off or my portfolio is off, and I need cash for whatever reason, Richard, as you know, that can vary. Mm-hmm. And boy, wouldn't it be great to have this available to me as a customer, right, rather than having to sell Amazon when it's down, or pick your favorite
That's
choice.
That's right. Selling an investment at a very wrong time through a turbulent market where I can tap this, but then at times when I get my appreciation back, if I would like to rebalance, I have the ability. So say I take $30,000 out of my home equity line, my home equity conversion mortgage line. I take $30,000 because I said, okay, I need to do this because I don't want to touch my equity portfolio. But once my equity portfolio appreciates again, I'm going to trim or rebalance, and instead of putting the money into cash, I'm going to go ahead and I'm going to pay down and get my line back, what I call get my line back, get it intact to what it was. So I've seen it as that. I think it's going to be very important as people wait for Social Security. We're very big advocates of people waiting until age 70 to take Social Security because that's the only pension they have. But as David Blanchett's great research shows, that a lot of people look to retire at age 62 or before full retirement age. This could very well be a formidable bridge for you to take payments before Social Security comes into play. And to your point, long-term care costs are becoming, that to me is the essence of financial vulnerability when I run plans. I don't know if people realize the crisis we're going to have when it comes to long-term care. Yes, few people can obviously self-insure, but for most, that is not an issue. And they're going to need to utilize this line for that coverage, or they're getting such increases in their current premiums of very good insurance, they need the home equity conversion mortgage line to pay off the premiums, and they don't lose the policies. But I think the biggest word here is flexibility. It allows you to have this ability to have money in case of any adverse conditions if you're disciplined enough, and yet not lose your home. So I don't see a lot of downside to this strategy, only because I had to live through some iteration of it through the financial crisis. And having these life insurance policies with cash values, having home equity lines of credit that weren't shut down, although many were, but to have that reverse mortgage option available to me and not having to touch the portfolio, I think is indispensable. And I think as most wealth is in people's homes, at least that's where most of the middle class have them, I can't see how this is a bad situation at all. I think it's going to be very, very important. And I also think it's going to be very important for advisors to get up to speed and integrate this process into their planning, which is what we do.
You have a supporter here with those statements, Richard.
Hey, last point. What resources would people who are listening to this, what were some of the best resources on the internet? I have a few of my own, but thought maybe you're the master at this. What 2 or 3 resources you would share as far as education for someone that's looking into this this process?
Well, sure. Yeah, I frankly, I guess I'll start with Wade Thaw has a book. If you're really truly interested and you have sort of a technical flavor, Wade has a very detailed book on reverse mortgages. He actually
sure
has a second edition.
Yes.
Yep.
Big fan of that
available.
book. Yep.
Yep, it's a serious read, though, for a consumer. It's a serious read. But
don't read it before you go to sleep, I'm telling you. It's going to take you some time to get through. So I think there's some members of the audience that would find it very interesting. But to your point, you're going to have to study this book and go through it time and time again. But he is on the second edition, and it's very thorough, and it's one of the best reads. Yes.
Yeah, so that's sort of the kind of the far end of the fairly technical type of content materials. I think and I truly mean this. I don't mean to sound self-serving.
No,
I think
please,
getting educated.
Do it.
I think getting educated by a quality reverse mortgage professional and really how the product works, similar to what we've talked through today. Make sure you understand the pros and cons of it. Make sure you really, if you get a quote, make sure you really understand what that involves. I think having someone as a trusted resource to really walk you through that educational journey, I think personally is the best way to do it. Reading, and I'm reminded because honestly, it's interesting. A few weeks ago, I had a wonderful woman who tried to read all kinds of things on the internet and read a column or two and ended up talking to 3 different people and unfortunately got so confused by it all, she talked herself out of it when she would have been a great candidate for it. And so I think on one hand, sure, have at it if you want to go and Google and do all that. I think you run the risk of there's just a lot of information out there, and some of it's confusing. And I don't want to say it's they're intentionally trying to misrepresent it. Just I think people get confused around some of that. So
they're
that
afraid.
Would be my advice.
And I totally agree with that. You got to be real careful when Googling certain things because even financial advisors, they don't see the benefit to certain types of insurance, so they have a negative. Everything about it is fairly negative, and we see a lot of misleading information. Not intentionally, but they're not what I call it. They're not studying enough. I see the same thing with reverse mortgages, and I see the same thing with taking Social Security early. So there's a lot of lack of knowledge, but it seems like there's people with the confidence to share whatever little knowledge they have, and a lot of it's wrong. So,
so let me, if I may,
yes,
I'll add two ideas. So our company does have, I think, a very excellent website. You can go and learn some basics there. If you visit the website, the 3 W's, www.reversefunding, funding.com. Certainly would encourage you to do that. And then the other, I'll give out a phone number, which goes to someone on my team. It's 1-844-804-3863. Again, 844-804-3863. You would be connected to someone on my team who's trained on really taking that educational approach. We're not here to really sell or high pressure anybody, but just really try to educate somebody on how it works, the pros and cons, et cetera, Richard.
Last point, and yes, and by the way, nobody here is collecting any compensation on reverse mortgages on this side at Clarity. We're here as fiduciaries to help. I also think there's some decent overall information as I've gone through it. I wanted to get your opinion. At the Federal Trade Commission, the consumer information, they have just a very generic how reverse mortgages work and so forth. And I've noticed it's not really good information or bad information. It's just here's what they are, here's what they do kind of thing. And I didn't think that was such a bad, maybe if you want to get out of the total strong opinion of it, this is just a pretty plain vanilla way of looking at them overall.
Well, good reminder. And we actually will include some of those documents in what we provide clients as well. But then I'm also reminded, I'll tell you who's been a very good resource in this as well, has been the National Council on Aging. Richard.
Yes,
And,
absolutely. I forgot about that, but yeah, absolutely. Go ahead and continue on that. Yes.
Yeah, I'm sorry. So they have some information available through their website, which I think is personally, I think it's well done. So it's I'm looking at one document right now. Use your home to stay at home, and it's the official reverse mortgage consumer booklet. Approved by the U.S. Department of Housing and Urban Development. Again, the National Council on Aging was involved in that and sponsored and published that. So, again, I would recommend that. I think that's a nice, well-done resource, Richard.
Hey, and I also think NRMLA, I also think the association does a really good job. At reversemortgages.org, I understand, well, they have an agenda. Well, take that aside for a second, and I just looked at it as an educational hub. And they have some really just very down-to-earth 25 ways on how to use a HECM. Yeah, I mean, really going through the steps, very clean. So I thought that the website does a good job, really, as well.
Great point.
You think so, too?
100%. Yep. I'm glad you mentioned that. Yep. Reversemortgage.org, O-R-G. Absolutely. Again, a good resource. They have a nice consumer guide right on the front page. Learn how reverse mortgages work. Certainly, to me, those are good, credible resources, and certainly you can start there in terms of just learning about it. But my advice is to really get engaged with a professional as quickly as possible, because it is a bit. I think, Richard, you'd agree with this. There's a learning curve involved here.
Absolutely. Absolutely, and you're going to have to help people overcome the stigmas, although obviously that's improving, and that was very good news for me to hear. So a lot of great progress on that side as well. And if we are correct about poor sequence of returns in traditional portfolios, people living longer, smart strategies, reverse mortgage or home equity conversion mortgage is really going to be a smart addition if used properly. So, Tom, thank you. Very much so for all the info.
Oh, my pleasure. Yeah, very kind of you to have me, Richard. Thank you.
My pleasure. Man, a lot of information, huh, Brent?
Good stuff, Maynard.
Listen, we got to bust some of this. This is really turning it over and really just giving that underbelly a rub.
Kind of ticklish.
Yes, just to help people understand that these are not bad products and you really need to understand them. So, and again, we thank you so much being with us here at Underbelly. I'm Rich Rosso, Mr. Clanton, running all kinds of controls.
Yeah.
We'll be back next week about college planning.
Oh, boy.
And the FAFSA.
Yeah.
And how don't leave money on the table when it comes to your kids. We're going to talk about that next week.
The Underbelly podcast is recorded before a live internet audience in the Clarity Financial Studios. You can catch us on iTunes, Spotify, Stitcher, and wherever better podcasts are found. From all of us at realinvestmentadvice.com. Thanks for watching.